Hi, it's Trey Griggs with Obsidian Wisdom. Today we'll be answering the question, how do I get over my fear of investing in stocks? When it comes to fear of investing in stocks, there are, I would say, maybe three places that you will start with. One is I have complete fear over the stock market because I've experienced a loss myself in some point in my life, or at least someone I cared about, maybe a parent or friend, someone I was close to, and I saw what happened when they lost their money. The second is I know that I sort of need to get involved in the stock market, but I'm not sure exactly where to start. I don't know how to choose a stock, how long to keep a stock, when to sell one, things of that nature. We all generally know that there is a process, but we just haven't been exposed enough to it to be able to figure it out. And then the third one would be I'm just not really sure exactly maybe how to goal set, whether I'm doing well, I'm in some stocks, I'm not in some stocks. I don't know exactly, how I'm doing. I would just be great if I could have some sort of a feeling of where I'm at, how I'm doing. Today, we'll discuss some key indicators that will help you, whether you're on any stage of that investment journey. So most entrepreneurs and families, they worry about money. So we created the Wisdomites framework to help you eradicate financial stress, generate a passive income, and build a prosperous retirement strategy. So when it comes to your fear of investing, I generally always start with the fact that it comes from the need of education. And what I mean is, at some point, we know we've experienced something along the way in this universe where we can tell that our creator has set it up in a way where there are rules and laws, that there is a consistent pattern, that there is the ability to make choices and get consistent results. Now, consistent doesn't mean 100% of the time things work out exactly the way that I thought they were. Sometimes you learn that the information that you were given was just inaccurate. Other times your expectations were inaccurate, and you learn from these experiences and you make changes along the way. So when it comes to starting out with educating yourself, it really becomes just understanding what the market is, what the average return is, setting realistic expectations, learning how to value a company, seeing whether it even makes sense for you to be an active investor based on the fees that you would have to pay, or maybe the amount of time that you want to invest in the stock market, or whether or not a more passive approach would make the most sense. When we are investing in the stock market, a lot of the times I would say that the people who it doesn't work out very well for, usually there was two things that they missed. One is they didn't understand that the process, as far as your time horizon, which just means how long I have before I need my money, that it's actually the opposite of what most people think. Most people think if I'm about to retire in 5 years or 2 years or less than that I really have to go for it because I have to make a certain amount of money in a short amount of time. You don't normally allow your time horizon to dictate your investment strategy in that sense of it. The way that it's supposed to work is, if I'm saying, you know what, I have 5 years to retire, well, technically that means that I don't have a lot of time to allow my money to ebb and flow, where I have some wins, I have some losses, because I don't really give myself only 5 years. So if you end up with a certain loss somewhere early in the process, you don't really have the time to make back from that loss. Versus someone who I would say has over a 10-year horizon, well, they have a lot more time, so they can actually be more aggressive because they have the ability to wait for the market to work its way back into, their good favor. And if you have over a 10-year horizon, if you're like a 20-year horizon, then you should be, obviously as comfortable as you can be, but you should be more willing to take some consistent long-term risk as far as choosing some growth companies versus just choosing like large cap or very stable companies. Your large caps are going to be like your Googles and your Apples, your Amazons, very large companies. Usually when you're saying large cap, I would say, anyone that's probably over $10 billion, you're probably going to find, okay, well, this would be a large cap company. Usually consider anyone under 2 billion would be as like a small cap. And the mid cap will be just as you'd expect. Somewhere between the 2 and the 10 million, you'd be like a mid cap company. As far as you're concerned in your investment strategy, the risk of having a smaller company that is going to be influenced by the economy is much larger than a very large company, right? Like The larger companies, they can withstand the losses of time, they can withstand the economic turns, and as a result, they usually are going to be there. So when you're getting close to the end of your investment journey, you actually want to have a strategy where you're switching a lot of your money from the high potential to lose it to where you are doing what's called capital preservation, which just means I'm going to make sure my money maintains itself even if the market is starting to have some significant losses, where I am managing some of that to make sure that I don't have those losses because I don't have the same time length that's going to allow me to wait for the market to bounce back. And you can use the most recent recession from 2008 as your example of that, where there was a 10-year span. If you were going to retire in 2008, 9, and 10, you were not able to make back the gains of your losses. I believe the stock market lost about 50% of its value during the worst of the recession. But as you've seen, we are hundreds of percents much higher than where we started. You just simply needed the window to allow yourself to ride the gains back. And so educating yourself on the market and the way that you should build your strategy would be the place that you'd start. And that sometimes that includes understanding like how to choose a company, right? Like if I really did want to be more of an active investor, well, naturally that means you have to figure out how much a company is worth, and then you figure out what the people think it's worth, or at least based on its stocks, what it's worth. And then from there, you can decide whether it makes sense for you to invest in that company. If you believe a company is worth more than what the market is saying, well, that means that you may be able to get it for a discount, which would be a great deal. If you believe a company is worth significantly less than what the market is saying, well, if you believe it's a good company, maybe you just put it on a list and you wait to see if there's ever a downturn where that business is now worth the value that you were expecting. And I'll put videos together where I can show you how to value investments, where you're able to determine whether it makes sense to buy one. Because the more information you have, the more comfortable you're going to get. The next thing you'd want to do is you really want to start building your confidence and remove your fear of investing by consistently investing, even if it's a small amount. And usually you do want to start with a small amount. The way I would have you think about it is if you've ever been to SeaWorld and you've seen the way like a trainer works with some of those very large animals, and it seems like they don't really have much of a fear. Or if you've ever been to the circus and you've seen different trainers work with like lions and tigers or elephants, and again, the same thing where you see that they don't really have a significant amount of fear. Their confidence is in the fact that they have worked with these animals day in and day out for an extended period of time, where they've either built a relationship with the animal, they at least understand the signs of when the animal is stressed or bothered, and they're able to know confidently, like, you know what, this is something that may scare someone that hasn't ever been in a cage with a lion or been on a stage with a killer whale. But me, right, as a trainer, I have been able to do this for a very long time, so I'm very comfortable in this environment. The same would be true if someone was uncomfortable with the idea of skydiving. Well, there are people who have skydiving businesses that jump out of planes multiple times every day. And so if you, again, had that same situation, if you had to jump out of a plane every single day, like 4, 5, 6 times a day, would you still be as uncomfortable with jumping out of a plane? And the reality is no, because you would learn so much from the experiences. And every time you're successful in your mind, it's going to be like, okay, maybe this isn't anything to be afraid of, right? Like, I've been doing this for so long. I know how to pack a parachute. I know the altitude I need to go. I know the angles I need to jump at, when to release my chute. I also know what the weather needs to be like for me to take the plane off, right? Like, you learn so much that you can't help but be confident through your experiences. The same is true when it comes to your investing. A lot of your fear has to do with just the lack of experience that you have. Go ahead and get started, whether it's something small, something that's consistent and safe, where over time, even that company will grow. It may not grow at the same rate as if you were being a little bit more risky in the sense of some of the stocks that you're choosing, but you can choose a company that is going to be here, that's not going anywhere, right? You can choose a Fortune 50 company, and a lot of those are going to be there. They're going to be okay. And then you can make decisions based off of that, where you're just like, okay, you know, I subscribe to a couple of investing channels. I read some magazines. I've subscribed to a couple papers like the Wall Street Journal or CNBC, whatever it is, and you start investing and learning, you're going to be like, okay, I can do this. The next thing that you want to make sure that you're doing is just like, the truth is just like anything. If you've ever been, I would say like to Vegas or something like that, and if you've ever seen those Vegas commercials that talk about gambling and how you have to gamble responsibly, they're often talking about you really have to have some predetermined goals set. You have to have a certain amount of money that you're going to invest in things that are maybe not going to work out for you, where you're just having some fun, which is totally fine. You can have some fun. If you were going to go golfing over the weekend, and let's say a round of golf cost you $50, $100, whatever it is, and then you said, instead of that, I'd want to take a stab at investing in the latest cryptocurrency or meme stock. Well, that's fine, right? To me, entertainment is entertainment. If that's how you find joy, then you do that. But understand that that is not what we would consider an investment strategy. That would not be how you would make sure that you build comfort and confidence in the market. Those are very volatile markets that have significant shifts, and it takes a much longer time to be comfortable with. But the same way that in investing, they talk about gambling responsibly, you have to have limits set for yourself where, okay, I'm going to put this amount and, maybe the catch it rich quick portfolio. And then maybe you'll say, okay, but I'll put the majority of mine in my steady growth retirement, right? You just have that ability to set up your own goals. And when the get rich quick portfolio fades away, well, you don't put more money in that. That's the next time that you have to wait for the next installment. Whether you put your money in the market every month or every quarter, however you want to do it, you don't get to put more money in there because you're like, oh, this is the one. It's just like if someone was in Vegas, you don't get to do that. If you want to be able to go to Vegas and come back home and have your regular life, then you have to set limits for yourself. You have to set goals for yourself before you get started. And then the last one that we'll talk about is you really just want to have an overall strategy. Now, throughout this entire conversation, I have been sharing with you different ideas and different possible strategies that someone could use to build comfort in their investments. Now, your strategy doesn't have to just be talking about like the risk protection where it's like, okay, my time horizon allows me to invest more aggressive because it's over 10 years and then a little bit less because it's getting closer to 5. And then I'm working on capital preservation because I want to be able to use my money within the next 5 years. And so it needs to be liquid and it needs to be available. Well, that's one portion of it. And then we also talked about just determining the risk that's determined with the growth of a stock. If you're in a large cap, do they grow? Of course they grow because of inflation and things like that. There's always growth built into the cake. But if you were trying to get large growth, then you would be trying to find the companies in the smaller caps. But the smaller caps is much more volatile and much more risky. But at the same time, all large caps started as a small cap. Amazon had to start like any other company with their first dollar in sales before they passed the $1 trillion mark. And so you could find the next Amazon or Apple as a small cap and ride that wave up. But at the same time, you could find the next small cap that was going to disappear off of the stock market and never be heard from again. And so you have to be able to determine, how much of my portfolio by allocation, that's generally how I would recommend, where that I can put in equities versus bonds versus real estate and other debt. And so you would say, okay, maybe I'm really comfortable with real estate, so maybe 30% of my portfolio is real estate, while someone else who may be less comfortable with real estate, but they're growing a confidence in the stock market, well, maybe you would decide, okay, well, I'm going to put 30% of my portfolio in large caps and safer companies. And then maybe I'll only put 15% that I'm going to invest in smaller caps because I'm not very comfortable with the chance of losing a significant amount of my money. And then you would decide from there how much you want to put in like real estate and other instruments, whether you want to work on like dividend stocks, where they're like larger companies that don't need the profits as much to focus on growth, but they give the money, some of the profits back to their investors. And that comes in the form of a dividend. So maybe you have an income strategy. There's lots of choices on how you can set up your overall portfolio, but just understand that you want to make sure you're taking into consideration your time horizon, your appetite for risk, and just what your overall goal is. Am I focusing on growth? Am I focusing on income where I want a certain amount of money to come in? Am I early in the process where I'm going to shoot for the moon? Am I further along where I need capital preservation? Your overall investment strategy is going to help you know whether you're staying in the lines. I would call your investment strategy your guardrails. You never want to cross a bridge without guardrails, because the guardrails help you feel a little bit more comfortable. Where if something one-off was to happen, you know that at least if all else fails, you would get caught by the guardrails. And, parenting isn't much different either, where along the way we end up having to teach our kids, guide our kids, walk our kids. And then we just start putting some guardrails in place where it's like, okay, where more responsibility is put on you. And these guardrails are in place to make sure that you don't go too far off, but I won't be next to you anymore. So that means you're going to be making some decisions on your own, lots of the decisions, but I'm going to give you where the edges are. So don't go over the edge, because that would be the danger zone. Your investments end up being kind of the same way, where you have the guardrails. You want to make sure that you have your catch-alls and that you're safe, but you also want to make sure that you're also growing your account along with the goals that you have set for yourself. If you have any additional questions about retirement planning, I invite you to check out my free retirement planning that works video training at obsidianwisdom.com/training. In it, I give you the entire Wisdometric framework that I use with my clients to help them eradicate financial stress, generate a passive income, and build a prosperous retirement strategy. Until next time, Wisdomites, remember, wisdom is asking the right questions to allow yourself to get the right answers. Keep asking those questions, and you will keep getting those answers. Continued blessings.